You know, we think of the market as a forge. It takes every single company, every stock, and it puts it to the test. It just hammers them with expectations, and then it quenches them in the cold, hard water of reality. And under that kind of pressure, well, some, they just shatter into 1,000 pieces, but others are tempered into steel. Today, right here, we are putting Bloom Energy on the anvil. Welcome to Iron Financial, the place where we cut through all that market noise to help you forge a stronger, more resilient portfolio. The question for Bloom isn't just about one good quarter. It's about whether this company, which has been supercharged by this white-hot AI narrative, has the fundamental strength to actually withstand the heat. We're putting it through the Iron Financial Forge test. So, let's get to work.
So this is it. This is the entire bull case laid out right here, straight from the CEO, K.R. Sridhar. And let's be perfectly clear, this isn't just another throwaway line from an earnings call. No, this is a declaration of a fundamental, tectonic shift in the market. You think about the AI revolution, the reshoring of American manufacturing. These aren't just little trends. They are seismic, once-in-a-generation events. And they are straining our old-world power grid to its absolute, undeniable breaking point. What Sridhar is arguing here is that Bloom isn't just selling fuel cells. They are selling a solution to the #1 bottleneck that could literally cap the entire multi-trillion-dollar AI industry. He's saying Bloom is selling power independence, and in an age of digital empires, well, that is the ultimate necessity. It's an incredibly bold and incredibly powerful claim. Okay, that's a fantastic story. I mean, it's a grand vision, for sure, and the market has certainly bought into it, hook, line, and sinker. But here at Iron Financial, we don't invest in stories. We invest in foundations. We are looking for the steel beams, not the smoke and mirrors. So we have to ask the hard questions, the ones that matter. Is this company actually built on a solid foundation of real execution, real profitability, and durable, lasting growth? Or is this just another hype train that's running on narrative fumes, priced for a level of perfection that, let's be honest, may never actually arrive? That is the central conflict we are going to hammer out today. Is it steel, or is it just smoke?
All right, let's really set the stage here, because the context is absolutely everything. This wasn't just another quarterly earnings report for Bloom Energy. For them, this was a moment of truth. You see, the narrative that's been driving this company for the past year has been singular and incredibly powerful: artificial intelligence. The massive, power-hungry data centers that are the brains of this whole revolution, they need more electricity, and more reliably than our aging grid can possibly provide. So Bloom's on-site, grid-independent fuel cells are positioned as the critical enabling solution to that problem. This whole narrative has created immense, almost unbelievable expectations, and the stock's performance reflects that incredible pressure.
Just look at this number, 469%. Just let that sink in for a moment. This isn't some penny stock, or a small-cap biotech that just hit a positive trial result. This is a major industrial energy company whose valuation has multiplied by nearly 5 times in just 12 months. A run-up like this, it builds a towering wall of worry and a mountain of expectations. The market wasn't just looking for a good quarter from Bloom. No, it was demanding a spectacular one. It was demanding definitive proof that the AI power thesis wasn't just a great story, but a hard reality being reflected in billions of actual dollars and cents. Anything less than an absolute blowout would have been seen as a catastrophic failure.
And let's be crystal clear about the problem they are claiming to solve here. We are talking about hyperscale data centers. So you need to thank Microsoft, Google, Amazon Web Services. These are not just server rooms in a basement. We're talking about facilities the size of city blocks, filled with computers drawing megawatts of power, 24/7, 365. Now, traditional utilities, they were built for slow, predictable growth over decades. They were never, ever designed for this kind of concentrated, exponential demand explosion. So, when a hyperscaler wants to build a new AI facility, their #1 constraint, their biggest headache, is power. Can they get enough of it? And crucially, can they trust that it won't go down? Bloom's entire pitch is that they can bypass that grid problem entirely. It's a very, very compelling argument, but it also means they have to deliver on an immense industrial scale, and they have to do it right now. No excuses.
Exactly. So the stage was set for this high-stakes showdown between the story, the narrative, and the actual numbers. So let's bring out the hammer and start breaking down the results. The entire bull case for Bloom, it all rests on one thing: execution. Can they actually translate this massive, undeniable demand into tangible financial results? Let's look at the hard data from their fourth quarter report and see if it really holds up under the pressure of the forge. The first swing of the hammer, revenue.
Wall Street analysts, the so-called experts, they were looking for about $655 million. Bloom delivered $777.7 million. That's not a beat, that's a demolition. It's an 18.7% beat over the consensus estimate. In this unforgiving market, where any sign of weakness is just brutally punished, coming in nearly 20% above expectations on the top line is a massive statement. It tells you that the demand isn't just real, it's actually accelerating faster than even the most optimistic analysts thought was possible. This is the first piece of hard, undeniable evidence. But look, top-line growth is only half the story, right? Any company can buy revenue if they're willing to lose a ton of money doing it. The real test of a strong operation is whether that growth actually flows down to the bottom line. So let's look at earnings per share. The Street's consensus was for 30 cents. Bloom delivered 45 cents. That is a 50% beat. 50%. This demonstrates some really powerful operating leverage. It shows that as they scale up production to meet this incredible demand, they aren't just getting bigger, they are getting more profitable. And that is the critical sign of a well-run, disciplined, and scalable operation.
Okay, now let's just put it all together on one slide. This right here, this is the anatomy of a blowout quarter. Revenue beat by almost 19%. Adjusted EPS beat by over 50%. And just look at adjusted EBITDA. That's a key measure of core profitability that strips out some of the accounting noise. They delivered $146 million, absolutely crushing the $107 million estimate by over 36%. Across the board on every single key metric the market scrutinizes, Bloom didn't just meet expectations, they shattered them. This wasn't a slight beat. This was a statement of pure dominance.
And you have to understand, this wasn't some one-time quarterly fluke or a single lucky break. Let's zoom out from the quarter and look at the full year. For all of 2025, revenue hit a record $2.02 billion. That's up over 37% from the previous year. What this demonstrates is sustained, accelerating growth. It completely silences the critics, who might try to claim this was just a single good quarter driven by a few large deals. The trend here is clear, and it is unmistakable. The company is building a powerful foundation of consistent, high-speed growth year after year. The numbers are simply undeniable.
Whoa, hold on. A fast car is great, but I want to know what's under the hood before I bet my money on it. Those headline numbers are impressive, I will absolutely grant you that. But a true forge test, it involves quenching, plunging that white-hot steel into cold water to see if it cracks under the sudden stress. We need to look beneath the surface of these so-called blowout numbers. Revenue growth is fantastic, but what was the cost of that growth? Are there any hidden stress fractures appearing in the financials that the market is overlooking in its current state of total euphoria? Let's apply some real pressure.
And here it is, the first potential crack in the armor. Non-GAAP gross margin. Yes, they sold a lot more product, but their margin, the actual profit they make on each dollar of that product, it actually fell. And it fell significantly. It dropped from 39.3% in the same quarter last year, all the way down to 31.9%. That's a 740 basis point compression. So the huge question is, why? Are they sacrificing price just to win these big data center deals? Are their input or labor costs rising faster than they can control? This raises a very serious question about the quality and the long-term profitability of this rapid growth. It's a significant stress fracture that we just cannot ignore.
And it's not the only one. It's part of a pattern. Let's look at the other pressure points. Operating margin, another key profitability metric, was also down year over year. Free cash flow margin, while it's still very strong, saw a significant drop. Then you step back and you look at the valuation. The stock is trading at a breathtaking 196 times forward earnings. That is a valuation that leaves absolutely zero room for error. And remember, as we saw just a minute ago, the stock is already up 469% in a year. When you combine compressing margins with a sky-high valuation, you have a recipe for extreme violent volatility. Which brings us to the $35 billion question, because that's the company's market capitalization today. Has the market, in its frantic excitement over the AI narrative, already priced in not just this quarter's success, but all of the potential success for the next 5 years? I mean, even if everything goes perfectly from here on out, is there any real upside left for an investor buying in at these levels today? That's the core challenge. The stock is priced for absolute perfection, but the margins are showing us clear signs of imperfection, and that is a dangerous, dangerous combination.
Those are fair points. They are absolutely the right questions to ask. The valuation is steep, no doubt, and margin compression is a real concern that needs to be monitored very closely. but you're judging the company by looking in the rear-view mirror. To understand a valuation this high, you have to look through the windshield. The market isn't pricing Bloom on last quarter's margins. It's pricing it on the incredible, visible pipeline of future business. So let's talk about the single most important element of the bull case, the backlog. This isn't a hope. It's not a sales forecast. This is the steel beam of contractually obligated future revenue.
Okay, so what is backlog? Well, in simple terms, it's the total value of products that customers have already signed contracts to buy, but which haven't been delivered or recognized as revenue yet. So a year ago, Bloom's product backlog stood at a respectable $2.5 billion. Today, it's approximately $6 billion. That is a 2.5 times increase in a single year. This isn't a pipeline of potential deals they're chasing. This is a mountain of signed, legally binding contracts. It shows that the demand curve isn't just growing, it's going vertical. This is what gives investors confidence that the revenue growth we just saw isn't a fluke, but the beginning of a long-term structural trend.
And it gets even better, because this is the part of the business that builds the real foundation. Every energy server they sell, it comes with a long-term service and maintenance contract. What this does is it creates a durable, high-margin, recurring revenue stream. A year ago, that service backlog was $9.6 billion. Today, it's around $14 billion. This is the bedrock of the company's entire financial structure. It's predictable, profitable, long-term revenue that will support the company for years to come, providing a stable base of cash flow even as the product side of the business scales up so rapidly. Wall Street loves this kind of visibility.
So you add it all up, $6 billion in product backlog, $14 billion in service backlog. That gives you a total current backlog of approximately $20 billion. Now let me put that number in perspective for you. The company just celebrated a record year of $2 billion in revenue. They have 10 years worth of that record revenue already locked in with signed contracts. This is the definitive answer to the valuation question. The market sees this $20 billion wall of future business and is willing to pay a massive premium for that level of visibility and that kind of explosive growth. And if that $20 billion backlog wasn't enough to convince you, just look at what management guided for the upcoming year. Wall Street analysts, even after this blowout quarter, were modeling about $2.57 billion in revenue for 2026. Management came out and guided for revenue between $3.1 and $3.3 billion. The midpoint of their own guidance is more than 24% higher than what Wall Street even thought was possible. This is the ultimate proof point. Management is so confident in their execution and in the demand they see coming that they are guiding for over 50% year-over-year revenue growth. That is the kind of forward-looking statement that justifies a premium valuation. All right, we've hammered the bull case with its record results, its massive backlog, and its frankly stunning guidance. We've quenched it with the skeptics' valid concerns about compressing margins and a sky-high valuation. Now it's time for the final judgment. We have run Bloom Energy through the iron financial forge. So what is the final product? Is this a genuine opportunity forged in steel, or is it a high-priced trap just waiting to spring?
Okay, let's walk through the test. The raw material, the core AI power demand story, is undeniably strong. It is. It's a secular tailwind that isn't going away for a decade, maybe more. The hammer of execution came down hard. The record Q4 results and, even more importantly, that staggering 2026 guidance prove this company can deliver at scale. That is not in question. But the quench revealed real, tangible risks. The margin compression is something you simply cannot ignore, and the valuation at 196 times forward earnings is, frankly, eye-watering. Those are legitimate concerns that mean this stock is absolutely not for everyone, which brings us to the final product. What we have here is a powerful, high-octane growth story. The execution is there, the demand is there, and the backlog provides a pretty solid floor, but it is built for volatility. That high price tag means any future hiccup, any perceived weakness in a coming quarter could lead to a very sharp, very painful pullback. So here's the iron financial verdict. Bloom Energy has successfully forged a solid foundation for a high-growth future. The backlog and the guidance, they provide a level of visibility that is exceptionally rare in this market. The AI thesis is real, and they are capitalizing on it masterfully. However, this is a high-voltage stock. The valuation prices in years of success and demands near-perfect execution going forward. This is not a buy-and-forget investment for a conservative portfolio. It is a calculated, aggressive position on a high-growth, high-risk player in one of the most important technological shifts of our lifetime, and it is absolutely not for the faint of heart. And that leaves us with the final critical question. The giants of tech, we're talking Microsoft, Google, Amazon, Meta, they are planning to spend over $250 billion on infrastructure in 2026 alone.
The AI arms race isn't just about chips and software anymore, it's a power race. Bloom Energy has positioned itself as a key arms dealer in that race, but they are not the only ones fighting for that prize. The ultimate question for investors is, who will build the critical infrastructure to power this revolution? That's the multi-trillion-dollar game being played out right now. Thanks for joining us at the Iron Financial Forge.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.